Hello everyone. Welcome back to the CAIIB Guru channel, where we break down complex concepts for your CAIIB exam preparation. Today, we're diving into an important topic, credit risk management and its organizational structure. But before we begin, let me ask you this. What does an effective credit risk management, CRM, structure look like, and why is it so important for a bank's success? Credit risk is a key area that banks must manage to avoid potential losses from lending. But why exactly is this so important? To put it simply, banks lend money to individuals and businesses, and there's always a chance that these loans won't be repaid. Credit risk management helps banks assess, monitor, and control these risks to ensure they can continue to operate smoothly while protecting their financial health. So, how do banks structure themselves to manage this risk effectively? The main goal of any credit risk management organization is to achieve a balance between risk and business objectives. This means the bank needs to make sure that the policies around risk are aligned with business goals, creating a sustainable approach to lending and credit risk. What's the balance we're talking about? It's balancing risks, returns, and capital constraints. Banks need to maximize profits, but they also need to ensure they're not taking on too much risk. This is where the structure of CRM comes into play. Now, you might wonder, who in the bank is responsible for credit risk management? Let's break it down into 4 key components. The Board of Directors. The board has the highest level of responsibility. They oversee risk management across the bank and ensure that risk policies align with business goals. They articulate policies, set aggregate risk limits, and review reporting and auditing systems regularly. They also determine the level of credit risk the bank is willing to take based on its capital planning. The Risk Management Committee, RMC. The RMC is a subcommittee of the board. It sets the guidelines for managing credit risk and monitors the risk measurement models. They make sure that the processes are in line with the bank's policies and ensure there are enough staff dedicated to risk management. The Credit Policy Committee, CPC, or Credit Risk Management Committee, CRMC. This committee is crucial in formulating policies related to credit proposals, financial covenants, and rating standards. They manage the delegation of credit approval powers and set prudential limits on large exposures. They are also responsible for overseeing loan portfolio management, pricing, and compliance with regulations. The Credit Risk Management Department, CRMD. The CRMD operates independently from the Credit Administration Department. They are responsible for enforcing prudential limits, assessing risk, monitoring loan portfolios, and identifying any problems that arise. They also create management information systems, MIS, perform loan audits, and evaluate portfolio resilience to external risks. Let's move to a very important point. Why do skilled personnel matter in credit risk management? Well, the success of any CRM structure largely depends on the people behind it. Skilled professionals in the credit risk management field are essential to properly evaluate risks, assess portfolios, and ensure that the processes are followed diligently. It's important for banks to evaluate existing competencies and provide training to staff. Recruitment from reputed institutions also plays a major role in ensuring the department has the necessary expertise. Let's quickly recap what we've learned today. A strong credit risk management organization ensures a balance between risk and business objectives. The key components of the CRM structure include the Board of Directors, Risk Management Committee, Credit Policy Committee, and Credit Risk Management Department. Skilled personnel are essential for successful credit risk management, and ensuring their competencies through training is crucial for maintaining an effective system. That's a wrap for today's lecture on the organization structure of credit risk management in banks. If you found this video helpful, don't forget to like, share, and subscribe to the channel for more CAIIB exam tips and detailed explanations.